Good morning. It is Monday, March 31st, 2025. It's just before noon on the East Coast, almost 9 a.m. on the West Coast. This is Rob Sin at CEO Technician on X, at Goldfinger on CEO.ca, and this is Goldfinger Capital on YouTube. A lot to get into today. And as always, if you enjoy these videos, if you get value from this, please hit the like button and subscribe. I appreciate your viewership and your engagement and also your feedback. I've been getting some really good feedback from viewers and Substack readers in the last few weeks. I really appreciate that. So let's get into it. Markets are shaking. They're kind of cracking, quite frankly. We know April 2nd, Wednesday, is a big day. What's going to happen on April 2nd? Well, there's been so much front running that usually the announcement is a bit of an anticlimax, right? So usually the moves ahead of a major event like that more than factor in the actual event, but we just don't know because this has never happened before. We don't even know all the tariffs and what the percentages are going to be and who will get exemptions or will there be. There's a lot of uncertainty, right? So that's the word. Again, non-farm payrolls also on Friday. So probably a lot of market volatility this week, a lot of trading opportunities for those who are nimble and are good at managing risk, but also a bit treacherous, quite frankly. This is a pretty treacherous environment. Speaking about non-farm payrolls on Friday, so the consensus expectations for that number has definitely fallen in recent weeks. And I wonder if it could even miss to the downside the lowered estimate, the consensus estimate of 128,000 non-farm payroll. So that's the consensus right now. I actually wonder if we'll get a sub 100K print, when it's announced Friday morning. And then the unemployment rate is 4.2%. That's the expectation. I would say that's probably what it's going to be. If somehow it gets rounded up to 4.3%, that would be not good. No bueno for stocks and for markets. So that will be the big event, I believe, Friday morning, U.S. non-farm payrolls. So on my Substack yesterday, and I'm showing you a premium article. So there are some benefits to tuning into these YouTube videos because sometimes I give away a little more. I published this yesterday on my Substack. The most important chart in a metal that could be vulnerable in April. Those who asked, I guess you didn't subscribe, so you have to ask because you couldn't read it. Yes, the metal is copper, and it's interesting that literally hours after I hit send on this, the futures market opened and copper dropped over 2%. Weird. So sometimes it's scary when I have a market outlook and then it happens immediately. It usually doesn't go like that. Anybody who's been around for a while knows that usually you have a market outlook and the market goes against you for a few weeks first, right? But the point I make in this is that we have a kind of a toxic brew of rising inflation and worsening consumer sentiment and consumer spending data, right? So anything that is in uh, the realm of I don't have to spend it, right? It's a choice. It's not a staple. It's not my groceries. It's not my rent. It's not my utility bill. But anything like yoga pants, going out to dinner, going to a sporting event, taking a vacation, right? That spending is getting cut back across the economy. And we're seeing this, I mean, just like, food service and beverages in February, wow, falls off a cliff. It'll be interesting to see this data in March. Also, retail stocks such as Walmart, Target, Lululemon, and there's many more have been thrashed since the beginning of February. You see the downtrend here, you see the downtrend here. Airline stocks trashed, right? So a lot of the real-time market data and even the hard data, certainly the soft data, is pretty negative. But even some of the hard data has started to turn negative. And then the market data, which is I think the best data, the real-time forward-looking data, is starting to flash some red light warning signs of a recession, right? And definitely rising consumer prices in the midst of declining consumer spending is characteristic of a recession, right? And Goldman Sachs raised their core PCE inflation price forecast to 3.5% from 3%. And just look at how much of a difference this makes. I mean, their previous forecast was that inflation would be at 3% or maybe a little bit less, and then start trending towards 2% in 2026. Well, now inflation is going to be well above 3% into almost mid 2026. And then only then will it start trending down, right? So that's not good that we're going to have over a year of above 3%, almost 3.5% inflation, core inflation, right? Core inflation. So that means the real inflation is like 5 or 6%, right? And then, you got to wonder what's going to happen on April 3rd once all this tariff front running, which has propped up growth, is over, right? Like what's going to happen? So it's one of those moments where I see a pretty high probability of a recession. And at the very least, even if it's not an official recession, we could get much lower treasury yields, right? And most likely, the Fed is behind the curve here. Goldman now saying 3 rate cuts later this year. I think I'm with them on that. But just the growth, right? There's going to be less trade due to tariffs. Employers have held off on hiring plans so far in 2025 due to the uncertainty. And so I think we're going to have a weaker economy in 2025. So these treasury yields, a 10-year treasury yield could absolutely drop under 4%. And sometimes, you get this setup where the fundamentals, all the data you're seeing then aligns with the technicals and the charts out there across markets. And this is one of those times, right? So I really getting higher conviction that treasury yields are about to fall. And so, you could play that with TLT or Treasury bond futures, ZN or ZB in the futures. But I don't think it's an overstatement to say this is the most important chart across markets right now. And really how this plays out is going to inform a lot of other market moves. The bearish wedge, within the context of a head and shoulders top there on the 10-year yield. And then I make the point about copper and just that this move we've seen in copper in March is unnatural. And it doesn't really align with the data that we're seeing out there across the economy. And I just wonder if the data continues to deteriorate in April and then the tariff front running is over, can copper just go straight back to 450 where it started the month of March at? I mean, it's possible. I think it's just it went all the way to 537 last week, 537 a pound. We're not in a deficit situation in 2025. Actually, we're in an oversupply situation or slight surplus, supply. And the economy is not accelerating. If anything, it's decelerating. Now, some people are going to say, well, it's China, and you just don't look at China. And you're right. I don't have a good grasp on what's happening in China, but I'm a little skeptical of that. And while it may have been China that drove it here in Q1, what happens once all the tariffs are announced and there's no more front running, right? I think there's a lot of questions there on copper in the near term. But I want to be clear, longer term, I'm definitely not bearish on copper. I'm quite bullish, but I think there's a near-term risk. It could be like an April, May risk that this all-time high price is not going to last, right? But I'm sure if it does reset back to 450 or 425, it will set up again and it will be another buying opportunity. I want to talk about gold. So I wrote literally Saturday, while investor sentiment is definitely favorable on gold, I'm still not seeing the sort of outlandish euphoria that typically signals a market top. Instead, it feels like many investors aren't participating in the gold rally. That was Saturday. Well, it's Monday, and 48 hours is a long time in this world in 2025. And so today I'm sort of reassessing that statement. And I'll tell you, I'm starting to see and hear some sentiment warning signs. Everybody's sure of a gold rally now. Everybody's clear on the fundamentals being positive and very favorable for gold. And there's some pretty wild price targets being thrown out there, right? So I want to be clear here in saying that I'm just offering a note, a warning note. Doesn't mean I think that 3150 is the top and that's it. No, in fact, I think gold will eventually go to 4,000. I don't know if it'll go to 4,000 this year or next year or the year after. I think the fundamentals, the long-term fundamentals and trend in favor of gold is quite clear and strong. But at the same time, I think 10% rallies over 1 month periods are unnatural. And just that rate of growth is unsustainable. Okay, so let's just be clear on that. Same thing about copper, like 20% in a month. That's unsustainable, 100% unsustainable. So we're seeing some unnatural movements out there across markets. These are not healthy movements. These are signs of dislocations and some panicking due to policy changes, right? And most likely, some of these moves will revert to the mean, okay? In a market as big as copper, you can pretty much guarantee there'll be some mean reversion. Gold is a little different because it's a monetary metal and it's a central bank metal. And that's why gold miners are cash cows right now, right? It has de-anchored from the marginal cost of production, right? Most commodities stick very close to the marginal cost of production. Gold is different. It's not really a commodity, it's a monetary metal. So anyway, that's quite a chart, right? That is quite a chart. And so to be clear, I'm not bearish on gold at all. But in the near term, this is a dangerous market that could have some crazy moves, both to the upside and downside. And it feels like we're in the final stage of a short squeeze in gold. And so maybe this market doesn't actually pull back in any appreciable way. And by appreciable, I mean like $150 or $200 an ounce, right? It's got to be that big when you're above 3,000 to be called a correction. It may not pull back in any appreciable way until the short squeeze is played out, right? Until that short, if they're out there, or shorts have covered. And who knows at what price that happens? It could be 3,150, it could be 3,200, it could be 3,300. We just don't know. But this is a dangerous market. And simply put, I think that if you're a longer term investor, it's just a time where you don't make any new bets. You don't necessarily change your holdings at all, especially if it's physical. I don't think there's any reason to sell physical here. But you just don't make any new bets. Don't get greedy. Don't make stupid moves and FOMO into some gold miners because you read a report from Citi and a $10,000 gold price target from some other guy, right? It's a more dangerous market. Okay, let's just put it that way. All right, so 10-year, housing affordability. So this is really interesting because the housing affordability is a very important topic, and it's one that's going to drive midterm election in 2026. Next year we have another election. Before the 2008 financial crisis, housing affordability got as low as, or as high as, 45% of the median income was spent on a median housing payment in late 2006, right? That was an unaffordable environment for buyers, for new buyers in the US housing market. And it helped to precipitate and result in a housing crash that led to a global financial crisis, right? And you can see that housing became extremely affordable in 2012 and 2013 when interest rates were low, housing prices had tumbled 50%, and incomes were still rising, right? So that was a great time. And that was a great time to be bullish on real estate. Well, now, fade the scene, 12 years later, and housing prices have more than doubled, and interest rates have more than doubled, and incomes are kind of lagging, right? So housing is unaffordable. There's very low affordability here. This is worse affordability than at the peak of the subprime housing bubble in 2006, right? And so some things gotta drop here. It's really that simple. There's two choices: either housing prices drop or interest rates drop. You choose which one is going to happen, because this situation cannot sustain itself for very long. It can last for a year, 2 years. I'm not even sure it can last 3 years. So we're getting to a breaking point, I believe, because just simply there's a lot of supply, there's a lot of inventory on the market, and not many transactions because the buyers just cannot afford it. So either interest rates are going to drop or prices are going to drop, or both, I guess. But I think that the scenario with interest rates dropping is more palatable from a political standpoint, from a Fed standpoint. And so that just puts another feather in the cap of the idea that this yield is going lower, right? This yield is going lower. Oh yeah, I want to make the point. S&P, we're at a big support level here around 5,500 in the E-mini S&P. We could definitely bounce a bit here. I mean, it definitely, maybe the tariff fears are a little overdone, but I don't trust this market, and I wouldn't trust a rally. I think most likely people will sell into that rally. And it's interesting how the DAX has diverged so much from the S&P. Remember I said there's a lot of dislocations across markets here in March, a lot of unusual things happening. Well, this is another one. European stocks completely outpacing and outperforming US stocks. So this is very clear there's a rotation of capital out of the US into other markets, namely Europe. Europe is opening up its fiscal checkbooks, spending big on military and infrastructure. Investors like that, stocks like that, right? And we're doing something else here in the US. We're isolating ourselves from the world. the America all alone strategy, right? And it's not working well in financial markets the last couple of months. So that's just something to make note of. And then that, exceptionalism, the US exceptionalism that we heard about in 2024, two of the stocks that were so exceptional were Nvidia and Tesla. Well, that was the goose that laid the golden eggs in 2024. AI, data centers, Tesla, Nvidia, Microsoft, Meta, right? Those were the geese that laid the golden eggs, and now they're not spitting out any more golden eggs. They're broken, right? These charts are broken, and they need to base out and find a bottom. But some major capital destruction. I mean, when you think of Nvidia's market cap, and then you think about a 30% drop, and all that money that's just gone to money heaven. Ouch, right? And so these were the leaders, or these are two of the leaders of 2024, and now they're leading to the downside, right? Let's keep going here. Copper conundrum. So yeah, we talked about copper a little bit. BNP Paribas has a very bearish outlook on copper, basically saying that the current pricing dislocation is going to end spectacularly terribly in Q2. We expect prices to collapse. So what does collapse mean? I mean, in my mind, that means like minus 20%. Like that's like all the way back down to 450. So it'll be interesting to see if that plays out. But food for thought that, and again, like I don't think 537 was based upon the fundamentals, because you see this supply outstripping demand. Already it was forecast to be 124,000 tons surplus. Well, now they're saying they expect copper consumption growth to slow to 2.3%. And so supply will be in surplus by almost 500,000 tons. That's a big difference. That's a big marginal difference in the copper market. And that's a problem if this forecast from BNP Paribas proves to be true. Okay. There's also a note from Citi. I don't have it up, but I'll just briefly mention it and summarize it. Basically, Citi came out with a bullish report on the gold mining sector. I think it was Friday, and their points are pretty simple. That gold miners are a cash cow here with these record free cash flows, record margins, record profitability, and you can just think that, well, gold's 3150, and we'll just say that the marginal cost to produce an ounce of gold is 1,500. Just use a round number, right? And so the margins are above 50% here, and it's never been like this in the gold mining sector, right? Gold miners have dealt with many environments where they were selling gold at 1,200 and they were mining it for 1,000, or they were selling gold for 1,700 and mining it for 1,300. They've never had an environment like this, right? So this is an exceptional environment of extreme profitability in the gold mining sector. The stocks have moved up, but they're not fully reflecting this, right? The market is not convinced that this is sustainable, right? But gold is a very unique metal, right? It's not really a commodity, it's a monetary metal. And so the fact that gold has this central bank component to it, all this central bank demand, makes it sort of de-anchored from its marginal cost of production, right? Other metals don't really have that, like with nickel. Actually, you could say that metal is trading under its marginal cost right now. Copper, that's why copper cannot get too far above its marginal cost, because there'll be more supply that eventually finds its way into the market. And then oil as well, right? Like if oil is 68, probably the marginal cost to produce a barrel of oil is 60 or something like that. Or definitely not less than 50, right? And so gold is a very unique metal. It's not a commodity, it's a monetary metal, and that has created this sort of perfect situation of profitability for the gold mining sector. So it was a bullish report, but this is stuff I've been saying for several months and other people have been saying for several months, so they're kind of late to it. So just interesting from a sentiment standpoint to see that kind of report coming from a major investment bank like Citi. Let's see what else. Uranium stocks. So look at how far copper has diverged from like the Australian dollar, which is actually the Australian dollar is kind of risk off here. Copper has gone the other way. And then, yeah, like Freeport has been volatile. It had a nice rally there off this low in early March. But look what's happened in the last few days. And then Rio Tinto, these charts don't look great, right? And these are companies that produce a lot of copper, right? And even with Freeport, they produce a lot of gold. But look at this chart, right? This is not a bullish chart. So there's a major divergence here, and one of these trends is wrong, right? And I think that I've learned over time that most likely the stock market is right here, and the currency market is right here, and this move is not sustainable. This 537 copper price. So that's my food for thought there in the near term on copper. We talked about gold, very dangerous phase in this gold market. And then final 2 points. So uranium stocks. So meanwhile, uranium stocks have been bombed out in 2025. I mean, they topped in November 2024, but now we're like 5 going into 6 months into a nasty cyclical bear market in the uranium sector. Sentiment's pretty awful here. Nobody's talking about uranium stocks anymore. I remember last year, there was a lot of people talking about them. And so I'm interested again here. I feel like once we get past this tariff stuff and we get a little more clarity in the world, well, we still need nuclear energy. We still need a lot of energy. We need power to power our lives. And so I think this is the time to look at NexGen and Cameco. I'm just going to keep it real simple. We'll stick with the two of the major brand names in the space. And NexGen, I mean, obviously they're in the permitting and mine building phase. So this is sort of the suboptimal phase of the mining life cycle to be looking at it. But this stock's been cut in half. $4 on the NYSE is a big long-term support level for NexGen. And I've just got to think that if the price gets a little lower, somebody's going to take a shot at this one, maybe offer a 30-40% premium to whatever 20-day VWAP. And even if they don't actually get to buy it at that price, it's still going to be a nice trade once somebody starts to make a move, right? And so I think this is, if you're a shrewd player, I don't know, like a Cameco, this is the time when you want to actually do some M&A when prices are down and you can get a better deal. So I like NexGen and Cameco here. I think this is the time to start building positions in these two pretty washed out, pretty oversold, at or near very important long-term support levels, and sentiment is pretty washed out on the uranium sector. I'm just I could probably make another video on this topic. It might even be tomorrow. But nickel, Talon Metals, First Atlantic, which is FAN on the TSX-V, Talon is TLO on the TSX. But nickel is also a metal that I think smart investors want to take a look at because it is so washed out. It is so cheap. It's the opposite of what copper's been doing. And just there's not a lot of nickel in the US, right? And so Talon is a unique story because this is a high grade deposit in Minnesota. Check out my Substack. This is a free article. I sort of break it down. They announced a new discovery, high grade, apparently very high grade, massive sulfide. So usually when they have 95% sulfides at this deposit, Tamarack in Minnesota, you'd expect the nickel grades to be well above 5%. The copper grades might also be above 5%. So, the equivalent grade could be somewhere on the realm of 8 to 10% for this new discovery. And there's a lot more to unpack, but the stock started to see a move after a long downtrend. We saw some interest in Talon last week. Very interesting. And you can see it's been bottoming for like 6 months. So when you see this impulsive move off of a very broad, well-constructed bottom, I mean, any technical analyst worth their salt is going to say, that's interesting. Let's see if there's more follow through here. So that Talon is one to watch. First Atlantic is another one. Nickel awaruite in Newfoundland. This one is not well understood. I'll just put it bluntly. It's not well understood. And people pegging it as low grade don't understand awaruite and this kind of ore body that's literally sitting right at surface, very consistent and continuous over very wide areas. So it makes almost a perfect setting for an open pit mining setup. And there's a lot of other advantages, right, to where this deposit is located. And they're still so early on. So people that are saying, it's too low grade. Well, there's a lot of other, deposits out there that are between 0.25 and 0.3% average grade for nickel that are at the feasibility or final feasibility stage. So, and also with much larger market caps than First Atlantic has currently. So still early days in the fan story. I mean, I think they're only like 5 holes in, right? But the results so far have been really encouraging. And the people who have done their research and dug a little deeper, I think appreciate that, right? So grade is important, but so is metallurgy. And just overall, you need to understand the full setting of an ore body, right? How continuous is it? How consistent is it? How deep is it? What mining method are we going to use to extract it? The infrastructure in the area, all those questions are very important. And First Atlantic kind of checks all those boxes. So that's something that I'll expand upon in the future. But that is it for this week's video. $3,100 gold. Wow. Just wow. Thanks for tuning in. Again, if you enjoyed this video, please hit the like button and subscribe.